Good afternoon, traders. I want to go over a trade recap for yesterday and today. I have been getting better and better and better every week with this strategy. It's really exciting, super cool, and I'm going to show you a couple tricks today that I can actually add to my previous video on how to identify trends and catch big moves. So let's get right into it. See you there. I'm going to show you the strategy now. On the 30-minute chart, we have the 100-point moving average, and you will notice Sydney session opens up and it runs away from the red line, the 100-point moving average. Asia session opens up and immediately pushes towards it. So what do? We go for a 2-to-1 or at least a push into the 100-point moving average. So that's the trade right here. And as soon as we start to push up, we can just move our stop. So it ends up being a 5-4, 5.4 to 1 R. But usually I'm going to risk about 5 points, okay? So next day, Sydney session pushes away. It starts to run back towards it. Asia session pushes up into, right, this critical structure. You see this top wick, right? It wicks it out, which the market likes to wick out other wicks, and pushes down. We sell, risking 5 points for an interaction with the 30-minute moving average, or at least a break of these lows. And it works. Next day, we open up away from it. Sydney down here, Asia pushes down. It starts to push back up. You buy, targeting the 30-minute moving average. Okay? If you're concerned, like here we have very, very hard structure. But if we look at the 15-minute here, you can see this little line. Come on, dude, let's go. So this was the 15-minute moving average, and look, it tapped right through it. So we still would have had a good trade. It just didn't hit the 30 on that day. Okay, the next day, Sydney session runs up into it. Asia session opens and runs right through it. So not really a trade, but I made a lot of money on this trade because this is, we break a critical high, we reject it, we put in sustained selling. If you watch any of my other videos, we take out a critical high, we hit the 30-point, the 100 moving average, right? We put in sustained selling, and then what do? We look for a wedge. Why do wedges work so well? Because what a wedge is buyers are expecting it to continue, and what happens? It fails. And buyers, and it fails, and buyers step in and it fails, and buyers step in and it fails, and buyers fails. It just keeps eating up stop orders. It's really, really strong, right? Think of it like as long as there's blood in the market, the sharks are going to be hungry. Okay, so if buyers are sitting with their stops down here, where do you think your target should be? Right? Big moves get eaten up. Big move gets eaten up, right? Big move gets eaten up. Happens constantly. Big move. All these buyers expecting it to go higher. What happens? It just drops right through it. Okay, anyways, next day, Sydney, right? Asia pushes down, we buy, moves into the 30. Sydney, Asia pushes down, we buy, moves into the 30. We have a bias here. All right, we understand that the volume is going to accumulate and consolidate back into the mean because these are low volume sessions typically. If New York put in a big sell session and we're way under the EMA, Asia session usually runs it right back up to the mean and then sells off or breaks through it. Again, Sydney session, Asia pushes up and it starts to reject. We sell. This is a trade that I took yesterday and it pushes into the EMA. Okay, and then we formed a wedge. And these are the last 2 days I want to show you. So this is Thursday and today. These are my trades. So let's get rid of the okay, and again, okay, we opened up, and at the time of writing this was my entry, and I was expecting interaction, but we could run all the way down to here, right? And on a smaller time frame, I'll show you what I was looking at for this target. Right, we had tapped into this and we had a high, low, right, broke through. So there's some air right in here is what I was looking at. I want price to come in between these wicks because we have sellers, buyers. Okay, so I was targeting this. So 30-point moving average, the 100 moving average was somewhere in here today. So that was my target this morning. And then I saw that we were selling off. So I saw that we pushed, fell. So on a push to here, I was expecting that we would reject and continue and take out these lows. So that was my trade. But let's get into the actual trades that I took today, and I'll use the 2-minute. Okay, so on Thursday, remember this is Sydney session, Asia session pushed up and rejected. I think I actually sold in here, and then I added here. So this is my sell. I was anticipating that we stay. So this, I'm assuming that this is going to be a wedge pattern, something like this. Right. So I'm selling here, and I'm willing to sell here, and I'm looking for it to take out a base and interact with the 30-minute candle 100-point moving average. Okay, it moves down and it does. I take another sell here, and it does as well. Okay, and then moving into London session, it was really choppy. So I set and forget it. I put my stop loss up here, and I actually floated an order up here, anticipating it might manipulate me out, stop me out, but I would get filled for the push down. Why? Because I've been doing this a long time, and in a situation like this, I think that New York is probably going to manipulate lows before it has any interest going high. So I'm just going to let this go down. So this is my trade. I went out, I came back, and it hit my target, and then pushed back up. I wasn't really interested in trading the rest of the day because I saw this. Right. This is again, this could be a potential wedge formation, and you can see that it kind of was wedge, right? New York manipulated this really hard and then popped right back to it. Okay, look how strong these things are. So this is a wedge, right? Generally, the wedge angle gives way, right? But this is the primary base, and this is the primary wedge. So we're still bearish. This is a short-term wedge moving up. This is a long-term wedge moving down. Long-term wins. Okay, and then we wake up today. The 100-point moving average was right. The 100-point moving average was right here. So this is Sydney session. As we push up against this retest area, I short right here with my stop above here. I'm willing to sell up here. If we push up and reject, I'll sell again, and I'm targeting the 100-point moving average. I win this trade. Okay, and I added to this trade as well. I added right here for a very small stop, risking a break of the lows. Okay, and these were my 2 trades this morning. And then I was looking at this, and I'm like, price could potentially run up here and then dump and hit somewhere in here or down here, or price could slowly move up all day long until London, come up here, and then go down. So I'm going to trade it here. If I'm wrong, that's fine. I'll trade it later up here to short down here. But I think that it's going to fade because, again, big breakouts get eaten up, right? Look at this big breakout. The very next day, everybody's buying here expecting for it to continue. And what does it do? Takes out the low. Everyone's buying here expecting it to continue. Where's their stop? Here. What do you think it's going to do? Take out the low. Right? It's probably going to take out this low today. But if we short right now, we have to put our stop all the way up here. So it doesn't make sense. Right? So that's why trading is difficult. You need to find very key areas to trade off of. Where did we reject previously? We rejected this level. So if during London, the price moves back up to here, as it moves above here, I'm going to look for shorts because it's going to take out some liquidity and then start to fall. And then I put my stop, and then I risk 2 or 3 points, and I go for a break of the low here. And there's another trade for you. Right? And I might be willing to, stop out totally up here, but ideally, this would be my trade. It would hold underneath these. If it suddenly broke out and then pushed back down, I don't necessarily want to take a full loss. I might cut 50% of the trade here, because if it does suddenly go back down, I'm like, okay, well, I mitigated my loss, but now instead of making $1,000, I'm only going to make 500. That's fine. Or maybe I add that position back in that I took off, right? But I don't want to put my stop all the way up here because that's a ridiculous loss, right? So I'll put my stop here, I'll go for a good 2.5 to 1. If it immediately moves in my favor, I'll move my stop like that. If it pops up and goes down and pops up and goes down, maybe I cut 50% of the trade off, right? Because my full actual stop is here, cut 50% of the trade off. If it then starts to correct, push up and fail again, then I'll add that back in and then move my stop back up here. Because if I'm risking, let's say, $250 here to make 1,000, and I'm $250 down, maybe I close out half of it and I take a $125 loss, right? Now if it goes up to my final stop, maybe I'm risking $300 in that. So okay, I've lost like $325, $350 trying to make 1,000. If it doesn't do that, I just make 1,000. If it does come up, I take 50% off, I lose $125, and then it goes back down and I enter in again, right? And it hits my target. Okay, I've made $1,000 minus the 125 I lost. Right? You don't need to always just use super hard stops. Understand that it could manipulate all the way up to here, but have a financial threshold. Right? If I'm trying to make $1,000 for a break of these lows and I'm down $500 on that, the trade really isn't looking very good for me anymore. And I'm probably just going to cut it anyways. I don't want to lose that much money. I want to be right quicker. If I'm down like $250 and then it starts to move in my direction and then starts to move against me again, maybe I just cut the trade. I don't want to be in a shitty trade. I don't want to get manipulated. I want it to move in my direction quickly. But if it does, or if it's just kind of bouncing around near my entry, that's fine. I'll just leave the trade on, because that's what happened here, right? Where were we trading yesterday? Here. So this was a really annoying situation, and you can kind of anticipate this because a London session loves to just go sideways for a while. But what you need to understand about market conditions, you have distribution, consolidation, manipulation, distribution. Okay, so if you're trying to catch the first breakout, you're probably going to get stopped out. You're like, okay, I'm going to put my short here for the continuation. It shorts, puts you in your short, and immediately sweeps the highs, and you get stopped out for a loss. Stupid. But me, as soon as it sweeps the highs and rejects it, now I'm interested in short, because I'm anticipating that there's going to be manipulation, right? I'm going to wait for like one or two things to happen before I understand that the market's ready to move. We manipulate buyers and they get stopped out here. We manipulate sellers and they get stopped out here, right? And then we manipulate the highs, we push down, I can short here, I can put my stop a little bit above, because sometimes, shit happens, and then make that target. All right, so let's say I want to risk $250 right here. That's a 6 to 1. That's $1,250. Not a bad day, boys and girls, ladies and gentlemen. Okay, I'll see you in the next one. Thank you for watching my videos. Please like and subscribe. I'm trying to grow this channel very hard. Thank you so much. Peace out, guys.